There are many ways for a multinational company to avoid paying taxes in the country that they operate in. In fact, the Organization for Economic Cooperation and Development, or OECD, says that as much as $240 billion is lost annually due to tax avoidance by multinational companies. Base erosion is when taxpayers use deductible payments, such as interest and royalties, to reduce the amount of profits in the place where their income is earned. Profit shifting is when multinationals move their profits from one place to another through intergroup transactions. A combination of base erosion and profit shifting happens when multinationals take advantage of tax rule gaps between countries so that the profit isn't recognized by any country, the so-called stateless income. The OECD hopes that the two pillars of its base erosion and profit shifting, or BEPS 2.0 initiative, will close these gaps in international taxation.
Pillar 1 essentially will reallocate profits from where the activities are conducted to where the consumers are. It's just to slice a part of the tax revenue to go to the authorities of the consumer markets. Pillar 2 essentially it involves a global minimum tax proposal. And again, if you look at this, what it essentially means is that if MMC operates in Singapore and it only pays, say, 5 or 10% because it enjoys a tax incentive, then under this global minimum proposal, they have to top up the tax in another country. Typically, that will be the home jurisdiction from where they come from. Pillar 2 will help to achieve the objective that countries no longer compete on tax factors itself. So this will stop the race to the bottom. Countries are trying to beat one another to reduce their tax rates.
Singapore's headline corporate tax is 17%, but many companies pay less due to tax reliefs and incentives. That's why Singapore is considering a minimum effective tax rate to top up to 15%.
If we're a subsidiary in Singapore of a US multinational or a UK multinational, then if we don't top up the tax at 15%, then they will. So we're sort of, catching the ball in mid-flight and taking a slice of top-up tax before it can escape up to the top of the pile. So some people could see that as being quite a nice thing, but I think what we have to look at, of course, is what does this mean if Singapore is the country that is offering the low tax rates? We're now potentially giving away that top-up tax to another country. And so, we're like playing piggy in the middle in many respects. You almost are forced into having a minimum effective tax rate to protect your own tax base, because otherwise somebody else is going to tax your income, again, in a country that's got nothing to do with the generation of that income.
Traditionally, Singapore has attracted multinational companies to set up here by offering numerous tax reliefs. But with the tax playing field set to be levelled, the challenge will now be to retain Singapore's value proposition to investors beyond merely a tax advantage.
Taxation is always a consideration for investors. It's not the only one. Far more important are easy access to markets, to finance, and talent. Far more important are the rule of law, the enforceability of business contracts, the quality of life, and political stability. And Singapore has always scored high on these essentials, and I'm very confident will continue to do so. I think what we need to do to stand out even more is to increase our welcome of talent and increase our levels of collaboration to spur innovation. We also need to respect or increase the respect for entrepreneurship and continue to do everything we can to encourage and enable it.
Given its small market, Singapore could lose tax revenue under Pillar 1 of the agreement. But experts say Singapore could also see net gains in tax revenue and other opportunities for companies here.
If you look at jurisdictions or MNCs that are currently not located in Singapore, but in another jurisdiction. So because of the Pillar 2 proposal, they may shift their location to a country like Singapore, where they holistically think that we have all the tax and non-tax factors that are conducive to their business environment. So it may well result in a net revenue gain for the government. And again, that is for MNCs that are currently not located. For MNCs that are currently located in Singapore, if they continue to base here and not shift to another place, then again, there'll be net revenue gain for the government.
The agreement was signed by over 137 countries and jurisdictions in November 2021.
Most of the largest enterprises have already factored this in to their tax planning and to their overall strategy. I mean, I think the thing to bear in mind that if we look across the world today, the growth markets are very much in our region and in Asia as a whole. And I think that alone will continue to attract investment by businesses that want to make sure they grow and sustain themselves, that want to make sure they have an opportunity to provide their goods and services to more consumers across more countries.
The OECD is planning for the global minimum tax proposal to come into effect in 2023.